All right. Welcome, everyone, to this Monday afternoon call. Hopefully, you have had your lunch. I just had mine. Had your afternoon nap. I just had mine. And you've had a good day at work, hopefully. I just had a great morning of work. And I'm excited to talk about the all weather strategies and what we're doing and what performance looks like. In addition, today, I'm going to be talking about Japan. We've had an overweight position in Japan for a while. And I'm going to be going through and explaining why I think Japan still has upside. But more than that, I'm going to identify a bunch of other stock markets that could benefit from what Japan's doing. And unfortunately, it's not Thailand, but for a good reason. So I'm going to explain all of that. Why don't we get started? I'm going to share my screen. So, hold on. Where is my... I'm trying to find my presentation. 1 second. Hold on. Share. Cancel. Okay, hold on. Just trying to find my PowerPoint to share with you. Okay, here we are. So I'm going to talk today about the January performance of the all-weather strategies and update things. If you've got questions, make sure to ask them in the chat because I love questions and I love to hear questions that you have. Remember that our allocations are global and they're long-term and they're diversified. And why are we here? Why are we even on this call? To build wealth over the long term. That's the key. That's where we're focused. There's 3 pillars of investing. One is to be broadly diversified. The other one is to contribute regularly. And the other one is to stay invested. Many people try to get in and out of the market and time it. That's not a great idea when it comes to compounding your wealth. I outline all of this. In fact, I taught all of this at Sassen recently in a course on how to start building your wealth investing in the stock market. So our goal is to deliver steady returns over the long run. AWS, the red line, was launched in February of 2019 and targets a 6% per annum return. Alpha Focus, the blue line, was launched in October 2021 and targets an 8% per annum return. And Inflation Guard was launched in July of 2022 and targets a 4% per annum return. Those are our goals, or what we're targeting with each of the strategies. And let's look at the strategies from when we started all-weather Inflation Guard in July of 2022. The strategies are performing almost as expected. So moderate risk AWS, though, has had the highest performance. We didn't expect that because we thought that Alpha Focus would have a higher performance. But remember, the market got hit hard. And when the market gets hit hard, I'm going to grab my pen and show you something. Because Alpha Focus is a much higher equity allocation, when the markets come down, all weather strategy comes down, but Alpha Focus has come down more. So in theory, when the markets start to rise, all weather Alpha Focus has the capacity to rise higher than all weather strategy. And that's my expectations over the long term. But in the short term, anything can happen. Now, all weather Inflation Guard has had the lowest return, but that's our plan. But it also has the lowest volatility. As you can see, the green line is much less volatile than the other two. Now, since July of 2022, all strategies were below the world equity, but with lower volatility. You can see world equity up here. From when we started, it was up 111, up from 100 to 111.2. Alpha Focus is up 106.5, and all weather strategy is up 109.3. Now, the problem is some people may say, well, Andrew, you missed this upside in the market. Well, we didn't miss the upside. Our strategies went up. We just didn't get up as much. Why is that? Well, because we mixed asset classes rather than holding pure equity. We try to avoid a portion of the equity market drawdowns. As we can see, none of our strategies crashed as much as the equity market during that period of time. However, that also means that our strategies miss the boom time. We are not going to capture as much of the upside as you can see because we're diversified across various strategies, various asset classes. Now, the benefit for you is it's less stress because in the past, we've gone down less. We have gone up less also, but in the end, we're pretty darn close. And therefore, owning all-weather strategy and being invested in it is something that hopefully reduces some of the stress of the markets. You see, we create our strategies for decades. Not even a decade is truly long-term. That's me when I was young. That's me when I came to Thailand. And that's what I'm going to look at when I'm 100 years old. Our aim is to create strategies that perform over many, many decades. So let's review the performance for January, which is all-weather strategy gained 2.3%. Alpha Focus gained a small 0.6%. Inflation Guard actually lost 0.4%. And then we'll look at some stock exchange reform in Japan and see how it awakens the power of capitalism. So let's go into this. First, we make no changes to our weighting, to our strategies this month. We are going to make changes at the end of, or let's say the beginning of March. For right now, we're 85% allocated to equity, with 25% in US, 25% in developed Europe, and 25% in Japan. Since inception, the all-weather strategy was up 34.7%. And that's about 13.4% above a 60-40 portfolio. Remember, this is also after fees. In January, the strategy was up 2.3%, which was 3.2% above the 60-40 portfolio. Our target allocation to Japan really outperformed massively. As you can see, that's 7.7. We got Japan right. Our target allocation to the US and to Europe did okay, but nothing compared to Japan. Let's talk about Alpha Focus. Here, we're 95% allocated to equity. We just didn't catch as much of the equity upside. So the strategy was down about 5.8% since inception, but about 3.2% above a 60-40 portfolio. So we've done quite well in that space relative. It's also about 0.4% above world equity, but with a lot less volatility. Again, we can see we didn't have all of that volatility that you see in world equity. Now, Alpha Focus is interesting because we also were in line, in most cases, with the market performance. Only a few times did the market perform really well and we were left out. So in January, the strategy was 0.6%, which was 1.5% above the 60-40 portfolio. So though it was a low performance of 0.6, it still was a strong performance above the 60-40 benchmark or portfolio. And out of our 22% tilts, World Energy and World Infotech did really well, while Europe small caps was a slight drag on the performance there. So let's now look at all-weather Inflation Guard, which lost 0.4% in January. Now remember, we're only allocated about 25% to equity. Most of it is in global bonds and TIPS. So since inception, the strategy was up 5.1% and about 7.1% above the 40-60, meaning 40% equity, 60% bonds. And it has experienced much less volatility. If you look at the size of the ups and downs of the index, the size of those ups and downs are much lower on our strategy. So this strategy really, you want to think about it as a strategy for somebody who has money in the bank. And they know they're not earning a huge amount on that money in the bank, but they don't want to have a major exposure to the stock market because they're afraid. This gives them that position, because if you look at it, it's only a 25% weighting in equity. So the World Equity Fund outperformed. We can see the World Equity Fund that we are owning is outperformed very well. And our allocation, 5% allocation to World IT did poorly. Of course, did okay. We can see right here. But what, didn't do well was our exposure to gold and global bonds. So it was a challenging period, but the fact is that we still outperformed the benchmark, which is what I'm looking at to try to make sure that we're delivering over time. So before I go into the Japan for a second, if there's any questions, feel free to ask those questions now, and I'm happy to address any questions about the strategies. So nice to see everybody. I see Sati says, hi, Andrew. And also Kunatip says, I have AWS and all-weather alpha focus. One of the things that I like to highlight is that investing is really about long-term. In fact, here's a statistic that I presented to my students in the Valuation Masterclass Bootcamp. I asked them this question, and I want you to think about this question. Over the last 20 years, did Warren Buffett outperform, perform in line, or underperform the S&P 500? What do you think? In the last 20 years, did Warren Buffett outperform, perform in line, or underperform the S&P 500? I'd love to see your guesses or your ideas in the comments. What do you think? Did Warren Buffett outperform, perform in line, or underperform in the last 20 years? I asked this to my students, and okay, we've got one vote right now that's come in from ABB, and that is outperform. What do others say? ABB is fast on the draw. Good. Doom 61 says outperform. Chart says outperform. Okay. The answer to this question is he performed in line with the S&P 500. He did not outperform the S&P 500. So Namwan says in line, I guess. Well, you're right. It's a shocking statistic, and I show it through a program, a software called Portfolio Visualizer, where we can see that what I'm saying is true. Now, the point is, though, in the end, in the long run, even though Warren Buffett didn't outperform over the last 20 years, he's going to end up with the most money at the end. And the reason why is simple. Basically, he stayed invested for 70 years. And that is really the secret to success. So the reason why I tell my students about that is because I want them to understand, don't think just because someone's an expert that they're going to outperform all the time. Don't believe everything you see or hear out there about outperformance. But most important thing is don't waste time timing the market, trying to get in and out. Build a diversified portfolio. And then with that diversified portfolio, what you need to do is then take that and continue to add to it. And then over time, after adding to it, let it grow. That's the key. That is the key. That's compound interest, exactly. So let me share my screen, and we're going to go into Japan and talk a little bit about Japan, because in this strategy, we are exposed to Japan. And so, but I'm having a problem with my screen. So hold on. See if I can figure out how to do this. Screen sharing was canceled. Make sure you click share on the modal and not cancel. Okay, hold on. I'm going to try to share my screen again if I can get it going. I don't know why. Hold on, I'm having a trouble, but I'm going to close my document, and then I'm going to open it again, and hopefully that will help me. Sorry about that. But we're going to talk about Japan because we have a significant weighting in Japan. So let's look at that. See if I can get this going right. 1 second. Okay, got it. So now I'm going to go back to where we stopped. And we're going to talk about the stock exchange reform in Japan is awakening the power of capitalism. There's been a decade of reforms in Japan, and it's finally taking Japan out of its lost decades. Japan has tried to become more attractive to investors since Abenomics started in 2012. And the Tokyo Stock Exchange released the Corporate Governance Code in 2015, and the latest revision was in 2021. Now, more than 90% of prime market companies have at least a third independent directors on their boards. They've also identified and disclosed the skills board members should have. This was added to the Corporate Governance Code to ensure a higher competency among board members. So what I want to just show here is back in 2008, only 33.6% of companies in what they called the first section, which they now call the prime market, only 33.6 had 1/3 independent directors. Now it's 92. So it continually rose. So the Tokyo Stock Exchange was restructured into 3 new markets segments on April of 2022. That's prime market for investable companies with good governance, and the standard market for companies with basic liquidity and corporate governance, and then the growth market for emerging companies with high growth potential and higher risk. Now, the market restructuring focused on investability, corporate governance, and unlocking company value. Now, almost 40% of the topics, which is 500, is the leading 500 companies in the Japanese market, trade below book value. We can see that same statistic is only 5% in the US, and in Europe, it's about 22%. So many Japanese companies trade below book value, which is very cheap. Now, small companies account for 16% of market cap, but 92% of those small companies are trading below book value. So all of this derating that's happened is all about the small cap companies. Now, if a re-rating only happens for companies trading at less than 1 times price to book, the impact will be limited on passive funds since they tend to invest in the largest and most liquid stocks. But reforms seem to drive overall sentiment. Now, these are the 3 things that matter most with regard to the Tokyo Stock Exchange effort. First, ensure companies are investable with large enough market cap, trading volume, and free float. Second, make companies deploy or pay out cash rather than hoarding cash. And third is full and simultaneous English reporting and disclosures to attract foreign investors. It's important to note that this is a very gutsy thing to do. In fact, I think most stock exchanges around the world don't want to push their companies too hard. Thailand also, I'm sure the stock exchange of Thailand folks don't want to push too hard on the companies, but the Japanese have been too lenient on their companies for too long. So let's take a look at what the Tokyo Stock Exchange is doing with the prime market. First, these are the companies that have the highest standard, and it's around 1,800 companies that are listed on the prime market. First, they want to ensure companies are investable with a large enough market cap, trading volume, and free float. So what does that mean? Liquidity requirements for the Japanese prime market, at least 800 shareholders. Ownership should not be too concentrated. And tradable share ratio of at least 35%. There should be enough shares available to trade in the market. And $170 million in market cap. The company shouldn't be too small if it's on the prime market. And $130,000 in daily trading volume so that the company needs to be liquid. Those are the liquidity requirements. And I would say that the toughest one out of all of these is just to make sure, I'm going to highlight, is this 35%. That's a large amount of free float that's required. So making companies investable is key. It's great to implement size and liquidity requirements to ensure companies are investable. However, the Tokyo Stock Exchange requirements won't be sufficient for many institutional investors. Generally, $500,000 a day in daily trading volume is needed even for relatively small institutional investors. So I wish that they had picked a much higher threshold for the prime market. Now, compliance and enforcement are also a matter that I think about. We still like the fact that there are liquidity requirements, and the least liquid stocks will still be liquid enough for retail investors. The Tokyo Stock Exchange has allowed a transition period until 2025 to fulfill the requirements of the prime market. It will be important for Tokyo Stock Exchange to take action against any companies not complying, for example, delist or move them to the standard market. If they have the guts to do this, it means the companies will follow. So, is the Tokyo Stock Exchange doing enough with regard to ensuring companies are investable with large enough market cap, trading volume, and float? What's my opinion? Well, I like that there are liquidity requirements. And as I said, they're liquid enough for retail investors. And I like that there's a transition period. But the Tokyo Stock Exchange must take action against any companies not complying and delist them or move them to the standard market. So let's look at the three things that matter most with regards to this. Let's look at the second item. Make companies deploy or pay out cash rather than hoarding it. So let's begin by looking at the past decade and current situation for context. Here we can see the return on equity of Japanese companies is definitely rising steadily. While ROE has been moving sideways in the US and Europe, Japan's ROE has been trending up in the past decade. And here we can also see that that's driven a lot by net profit margin, which is rising very steadily and therefore pushing up ROE. So this increased profitability has led to high cash generation. And that's where we can see that Japanese companies have been hoarding cash over the past decade. They're now sitting on $2.4 trillion in cash, an equivalent to 48% of GDP. So the Tokyo Stock Exchange takes aim on capital efficiency and valuation discounts. In March 2023, the Tokyo Stock Exchange asked companies on Prime and Standards to improve capital efficiency and reduce valuation discounts, considering and for them to consider the cost of capital or the cost of equity from the investor's perspective, to use a multifaceted analysis and evaluation based on the investor's perspective, and inspect the balance sheet to ensure efficacy, including the name and shame list to reduce the valuation discount. Here we can see an article in January 15th of 2024 where it says Tokyo Stock Exchange has published a list of companies that have disclosed information regarding action to implement that is conscious of cost of capital and stock price. Basically, they have a list of companies that have disclosed regarding their actions. And so they are naming and shaming. Now, there's massive cash holdings have yet to be deployed. We can see the dividend payout ratio has mostly stayed at about 35% in the past decade, though cash could also be deployed in M&A or company projects or share buybacks. So, is the Tokyo Stock Exchange doing enough with regard to this, to deploying cash or paying out cash? Well, there's nothing mandatory in there, and it's basically a name and shame and some educational materials. And while some companies may not improve, we think it's a good approach, as companies and their owners must be allowed to decide what's a good cash level. So I don't like to see the government forcing something, but I do think that the government is encouraging rather than enforcing. And I like that balance between forcing and encouraging. That many companies have started reporting their plans on how they will improve shows that they at least care enough to tell investors that it's important. Finally, the third thing, full and simultaneous English reporting and disclosures to attract foreign investors. English reporting is essential in attracting foreign investors to the Japanese stock market. Here we can see that currently 98% of prime market companies make some disclosures in English. And what we can see is that 90% plus companies publish earnings reports and notices of general shareholder meetings in English. Well, that's good. While only 25% of companies publish their annual report in English. And less than 50% of prime listed companies publish earnings in English and Japanese simultaneously, meaning they release English and Japanese at the same time. So there's still a lot of room to improve there. So is the Tokyo Stock Exchange doing enough with regard to the English reporting? It's likely to take time to implement, and it's voluntary, of course. And in this case, I think Tokyo Stock Exchange should make it mandatory for listing, at least on the prime market, to disclose everything in English and simultaneously with the Japanese version. I think that they need to be tougher on this, because if a company doesn't want to do simultaneously disclosure, then maybe it doesn't really want foreign investment money that much. And then they should be moved down to the standard market. So the Japanese government is also taking measures that could help the stock market. The government incentivized retail investors to invest. In January, Japan improved its tax-free stock investment program for individuals, and they're tripling the annual tax-free quota to about $24,000 for an indefinite period instead of the previous 5 periods. So you can put up to $24,000 and let it grow over the years. Now, Japanese households sit on more than 50% of assets in cash and deposits. They're sitting on a ton of money. In fact, Japanese households only have about 12.9% of their assets in equities. So we could possibly see more households investing in the stock market with the current low bond yields. And the revised NISA program is off to a good start. In the first 2 weeks through January 19th, retail investors bought stocks for $3 billion through these NISA accounts, which is nearly 3 times the previous month record set in 2020. Though retail investors were net sellers of Japanese stocks, and they invested abroad. So domestic retail demand is yet to boost Japanese stock prices. So I think there's still more to go. Now, efforts by the stock exchange and the government seem to have improved sentiment already. In 2023, they saw foreign inflows of $43 billion to the Japanese market. That's the largest since 2014. And that's when we had the data. Our data ends on 2014. Now, another 17 billion has flowed in 2024. That's impressive. But it's important to remember that capitalism doesn't stem from government. Government does not help capitalism much. Intervention by governments and regulators can often have unintended negative consequences. And most of the reforms in Japan are voluntary, which could make it hard to get adoption across the board. And in a year or two from now, we could find that market sentiment improved, but not much change happened at the corporate level. That's a risk. Also, forced reforms can become box-ticking exercises. Corporate governance code also included box-ticking requirements related to ESG and DEI and increased the regulatory burden. I want to talk about ESG for a moment. I know many people bought ESG funds, and the Thai government was pushing the ESG funds. But what I would argue is that the ESG funds are almost guaranteed to earn a lower than average return if we were to compare its performance against a similar strategy. And that is because you have to remove a certain number of stocks from the universe. There's other reasons, but I'm surprised to see that so many people in Thailand bought the ESG funds. So leaders may not be serious about improving capital efficiency and also consider it about ticking boxes. Maybe it could be that companies don't want to improve no matter what the government does. And so companies move to markets with lower requirements, or subsidiaries or affiliates are taken private to not have to deal with the government's, with the stock exchange. And requirements result in more delistings or fewer new listings. That's a risk. So what are the key takeaways? In our view, there are three things that matter the most in relation to the Tokyo Stock Exchange effort. Ensure companies are investable with large enough market cap and trading volume and float, and make companies deploy or pay out cash rather than hoarding and sitting on it, and full and simultaneous English reporting and disclosure to attract foreign investors. Many company boards and management appear serious about improving capital efficiency. Most improvements are recommendations and are voluntary, which could make it hard to get adoption across the board. And corporate governance has improved significantly, and the trend is promising. And the strong performance of the Japanese market and increased foreign inflows is evidence of improved market sentiment. Overall, this could trigger the revival of capitalism in Japan. Now, I want to talk about Korea for a moment. I wrote this piece in 2016. I actually took that picture in a restaurant in Korea. And Korea has a massive discount problem. And it stems from many reasons, which I highlight in this article. But the point is, could Korea be next? Currently, 44% of Korean stocks trade below their book value. And on the 17th of January, the Korean Financial Services Commission chairman said that the FSC intends to take measures to reduce the valuation discount. Korea is likely to be inspired by Japan. Now, liquidity requirements will be good for most Asian markets. Over the years, I've looked at the size and liquidity of Asian markets, and almost every listed stock in China is large and liquid. China is the most liquid liquid market in Asia. Japan and Korea are okay in terms of trading volume, but for the rest of Asia, 70 to 90% of listings are illiquid, which means more companies are hardly most companies are hardly traded in the market. And really, the stock exchanges should improve this. Now, the markets that are particularly illiquid are India, Vietnam, Singapore, and Philippines. If the regulators in those markets woke up to the idea of what Japan is doing, I would expect that those markets would have an upside. Now, before we get into Q&A, the Valuation Masterclass Bootcamp 14 starts on March 4th, and we help financial professionals become value experts in months rather than years. We have many previous attendees that are coming from Finnomena, and I'd like to welcome you. We had Chat Chada, who was an advisor and attended, and Tosaporn, who works with her, also Takon or Kelly, who's a teacher of finance, who joined the Valuation Masterclass Bootcamp, and Jutamas also came from her connection with Finnomena, and Boonsum came also through his connections with Finnomena, and Pongsakorn came from his connections with Finnomena. What do you get? It's a 6-week guided intensive online valuation bootcamp. We have daily live sessions, team support, and progress tracking. And basically, you get to write and present a professional valuation report. So you get an extra $100 off. So you'll save $800 by using the Finnomena code at valuationmasterclass.com/bootcamp. I would love to see you in the bootcamp. We're going to have a lot of fun in the next bootcamp. All right, it's question time. I'm going to stop sharing my screen and shut down. And now let's see if you have any questions. Feel free to ask those questions. Okay, the first question comes from Pitt. Pitt says, let me show this. Hi, John Andrew. What is your perception of the all-time high markets right now, US, Japan, and India? Is it too risky to invest more now or should wait for the correction? Because, think about Warren Buffett. He didn't outperform for 20 years, but he still ends up with a huge amount of money. That's because he stayed invested in the market. So I definitely think that the way to think about allocating your money is tilting a little bit here, tilting a little bit there, rather than getting out and getting in and getting out and getting in. So the first thing I would say is the US stock market is not expensive. 7 companies are expensive, but the rest of the US market is definitely not expensive. And so therefore, you just have to be careful. If you can get exposure to, for instance, mid-sized companies, then you're going to have, a very relatively stable performance. Eventually, the tech companies will come down. And so if I had to look at all the markets, I would say the U.S. does have risk involved. And you can see where we have a small exposure to the U.S. relative to what would be a neutral exposure. So Japan, I would say Japan is not expensive. So I think you're wrong in saying that markets are high right now, US, Japan, and India. India is expensive, but has strong earnings growth behind it. So right now we don't have any heavy exposure to India, but I would say that India has a good long-term story. It may end up that it's expensive for a long time because there's a small amount of investable companies there. So out of the US, Japan, and India, I would say the US and Japan have some level of froth in the market. And so it maybe reduce some positions in those 2 markets. All right. Are there any other questions? You may be thinking, Andrew, I got to go back to work. Me too. In fact, I'm going to go to a funeral after this of my neighbor, unfortunately, recently passed away. Sad. All right. So how about China tech stocks? Should we buy it? If you look at my strategies, I don't have any overweight position in China. So I wouldn't say that it's the right time to go into China. Now, I would say that China is probably getting close to a bottom, but I think the pressure from the US is still going to be pretty strong. And so I'm not a buyer of China at this point. It could be that the tech stocks are really volatile and they bounce back when China starts to bounce back. And that could be, interesting. But for me, I wouldn't spend time on China right now. That may change in the beginning of March. Sati says, I got new money to invest in current AWS and all-weather Alpha Focus. You suggest to all in or DCA? I would say that it depends on how much money it is relative to your overall portfolio. If it's 1 or 2% of your overall portfolio, then I would say you just put that money in. But if it's a larger portion of your overall portfolio, I would say do DCA with it because you're never going to go wrong with DCA. So that would be my answer. Chot asked the question, do you still think recession is coming? Yes, I still think so. And I think that it's, my expectation was the end of last year, or at that time I said the end of last year or the end of first quarter. So I still think it's possible by the end of first quarter, but it may end up that it's in second quarter. But I do still think that the U.S. has a recession coming. Excellent questions. Any other questions? It's quiet today, but your questions are excellent. So I don't see any questions coming in. I may get one or two as we come in. I just want to thank everybody who attend. I know it's Monday and it's early afternoon and you're probably working or whatever. So I appreciate you taking the time. Last time we spoke at about 7 p.m. and I was so sleepy because I get up very early. In fact, this morning I got up about 3 a.m. When to invest in Chinese stocks? I would say maybe 6 to 12 months from now. What I think's happening is the U.S. is just trying to crush the Chinese economy and the Chinese stock market. And they're doing it by stopping allocations to China, by scaring the pension funds and others in America about investing in China. Like there's some risk if they do that, they can't get their money out. And so I would say we're probably talking about, 6 to 12 months before we get to the bottom. Again, as regards to China, we are definitely close to the bottom. It's just a matter of what the environment looks like. Pongsakon says, hey, apart from hedging against the risk, are you planning to seek alpha through bonds as well in the near future? I don't really, my bond portion of the portfolio is not so much to get bond upside, it's to protect against equity downside. So I'm not expecting big alpha, but I do think that if my scenario is right and we see a recession, you're going to see the Fed reducing interest rates. And when they reduce interest rates, we're going to see bond prices rise. So in theory, we should do well with the bonds. If you are interested in China and you don't have exposure to China and you're thinking about getting in, we're definitely close to a bottom, and DCAing into China is not a bad thing. I would say that that's okay. I just think that there's some political motivations from the US that could be a dampener. But as long as we don't have war or something like that, and you can get your money out of China, then I would say that Chinese stocks are starting to look very cheap. Yep. All right. Other questions? I think it reminds me of one of the most important things about investing for the long term is that the time that you should be investing is the time that it feels the worst to invest. Like when the market is down and you just feel crappy about the Chinese market, or maybe you lost money in it, but eventually it gets so bad that eventually it makes sense to start having exposure to it. And so that's where you want to buy, as they say, when there's blood in the streets. All right, I want to thank everybody for joining today, and feel free to ask myself or your advisors at Finnomena, and if you have any questions. One last question that came in is, what are the risk factors that make you think about the U.S. recession? Well, first of all, I don't think you can tighten interest rates like they've done without it having a negative impact. The second thing is that we know that much of the growth that came in America came from stimulus, and that stimulus won't last forever. The third is that we have an inverted yield curve for a long time, which is usually a signal of a recession coming. And then The other thing is that we're at peak profitability. I mean, U.S. companies are really strong, so there's only one way to go, that is down. And those are some of the things that I'm thinking about right now. Also, unemployment is at its peak, and every time unemployment's at its peak, it usually signals a peak to the market and a potential collapse. Those are some of the things that I see right now. All right, that's it for today. I want to thank everybody for coming, and hopefully you learn something and you stay invested no matter where you're invested. Have a great day. I'll see everybody next month.